Good afternoon, everybody, and welcome to Stone and Chalk. My name is Marianne Lampertang. I'm the General Manager of Stone and Chalk in Sydney. Before I introduce you to Michelle Deaker, I just wanted to give a brief welcome and explain what we do at Stone and Chalk. Okay, so Stone and Chalk's been around since 2015. We were set up to be a centre of gravity for fintech. We were set up in Sydney with about 40 startups, and now we have about 70 startups in Melbourne, about 35 in Adelaide, and about 100 in Sydney here. So while our focus was traditionally fintech, we've actually expanded in different sectors. So for example, in Melbourne, we do agtech and medtech and cybersecurity, and in Adelaide, our focus is on defence and space. In terms of what we're trying to achieve, we've got two real missions. The first one is to help our startups commercialise and grow. And the second one is to help our corporate partners actually connect with the startups to help them solve a lot of their business problems. And in terms of how we help our startups commercialise and grow, we give them access to what we believe are the 5 things that they need the most, which is customers, capital, expertise, talent and community. And tonight's event is a classic example of how we're helping them with programs for capital. Before I hand over to Michelle, I just wanted to explain how Stone and Chalk works. So in Sydney, we have about 520 desks, secure offices as well as co-working spaces where our startups come. And we have over 20 corporate partners across Australia as well. So if anyone's interested in joining the family as a corporate partner or a startup, please come and see me after the event. I'd like to now introduce Dr. Michelle Deaker, and she'll introduce the OneVentures team. Thank you.
Yeah, thanks very much. I'd like to thank Stone and Chalk for supporting us in hosting this event. And just to kick off, I just wanted to give you a little bit of a rundown on OneVentures, and partly to help you understand when is the right time to engage with us and how to engage with us, and a bit of background about our team. So just a little overview. You know, we actually were founded 10 years ago this year as our first fund. So I'm very proud to say that we've now got 400 million under management across 4 funds. And we've got 21 active portfolio companies. We're adding to our portfolio companies on a fairly regular event. And we're backed by actually about 140 high net worths and family offices. And we manage about 105 million for the Australian government, which we also won through competitive tenders. And we were founded by founders. So many of us actually have sat in your shoes. We've built and grown companies. We've raised capital. We've done the hard yards. And we've moved to the other side, started angel investing, and then become venture capitalists. So when OneVentures works with you, we're really here to create a partnership with our companies to help you accelerate your business and to help you grow and hopefully achieve a successful outcome for yourselves and for the shareholders and other investors around the table. So we see ourselves as the extra pair of hands that you need when you're building your company. So I mentioned that we've got 4 active funds. We're raising a 5th fund, which will be a growth fund. So for companies probably north of 5 million, but probably in that 10 to 20 million range, we're looking to do investments in that area, and that'll be a $200 million fund. Our venture credit fund, we're talking to you tonight about the credit product. We've found we've had to educate both companies in Australia and also investors in Australia and shareholders about what it means to take the product and when is the right time to take the product. And we've got a healthcare fund that we're still actively deploying capital out of if any of you are in the healthcare area. So we like to build really great transformative companies, and many of these in our portfolio company we're really proud of. And I'll just mention a couple. Vaxis is our vaccine nanopatch company. It's working with just about every pharmaceutical company in the world, and it's going to replace 18th century technology for the delivery of vaccines. So you will no longer have to have your arm jabbed when you need a vaccination. It's a really exciting company. Focus is our business intelligence and insights company, and it's rolling out globally all around the world now, right up into Asia. And this company, we think, could be the next WiseTech of Australia. So we're very excited about having that in our portfolio. Another company you may have heard of is Employment Hero. Employment Hero just did a Series C financing at a $100 million valuation. We were the first investors in there and actually helped structure the company so that Employment Hero could become its own business. So we do come in and we actively help companies in our portfolios. We also help them acquire part of their payroll provider. So we really do work alongside you to build value in your business. And just to, provide some context around notable transactions, because many of these companies are worth hundreds of millions of dollars now, and we invested when they were worth sub 10 million. I think the combined portfolio, the value of the assets there is over $2 billion. Another example of a major licensing deal we did for one of our portfolio companies, Hatchtech, was a $279 million licensing deal in the US to a NASDAQ-listed company. So here are some of the companies in our local portfolio. I think we're going to hear from Shippit tonight, which has actually taken some venture debt, and you'll be able to ask questions why they did it and their rationale behind it. Just to tell you a little bit about the team, some of you know my background. I started life as an entrepreneur. In fact, I was probably one of Australia's first fintech entrepreneurs. I started my first business at university, which was in education, tertiary tutoring company, and then I went into computer hardware and software, and then I saw the opportunity for the dot-com one era, and I was a dot-com one entrepreneur that actually made it through the tech crash and out the other side, and sold my business to a UK publicly listed company. Then I started angel investing, and here we are today with OneVentures. Paul Kelly, my other managing partner, Paul founded Gemini Genomics, which in Australia at the time couldn't raise any capital, so he took it to the UK, and it became the UK's largest biotech listing on NASDAQ. Sadly, not Australia's, and he was the NASDAQ CEO, and then he did another NASDAQ turnaround and took it from a 30 million market cap to a 300 million market cap. So we do really know how to create substantial businesses, and I think amongst the team there's maybe 4 or 5 NASDAQ companies that have come either from our direct experience on the operational side or as investors and board members. Anne-Marie Burkle, our third managing partner, she's based in Brisbane, so not here this evening, but Anne-Marie is probably regarded as one of Australia's best early-stage commercialisation managers. And before we met and she came to join us in the establishment of OneVentures, she ran an iLab incubator for the Queensland Government. So Anne-Marie, Paul and I have been together for now 10 years building this firm. And I would also like to mention Grant Chamberlain, who's up the back. Grant's now a partner at OneVentures. He's been with us for over 2 years now, and Grant was formerly head of M&A and financial sponsors at Merrill Lynch, and he's done over $50 billion in transactions. Personally, we also have a couple of venture partners in the US, Dan Baker and Jim Scoper, and Nigel Dews recently joined us as a venture partner, and I think Nigel's here as well. Up the back. In fact, a lot of the team are up the back, so please feel free to talk to people from OneVentures. And, Nigel is probably well known. I knew him in his days as head of F2, Fairfax Digital. Obviously one of the big portfolio companies that came out of there was Domain. He successfully built 3 Mobile in Australia and did the merger with Vodafone and was CEO of Vodafone. And Nigel works actively with us in an operational role with our portfolio companies. He worked for Hutchison in Europe. He's worked with private equity-based companies in Australia, building those businesses as CEO, so we're really glad to have him as part of our team too. I'm going to really now focus on the venture credit team, but you'll see those faces, many of them are in the room, and we have a great team of people working with us and a wonderful board. So Nick Gainsley comes to OneVentures from Kreos Capital in Europe. And when we were setting up the venture credit program, we realised that there wasn't really anyone with deep domain experience in the venture credit product in Australia. There were people with other related experiences, but who hadn't done 100 companies and invested about 500 million Australian, and had seen this product through many companies and many life cycles of companies, and knew how to deal with different situations, because not everything always goes in a straight line, as you know, when you're building a business, and you need investor partners who know how to support you in that. So Nick spent many years, and he'll talk more about his background. James McGrath has been 4 years in OneVentures, and prior to that he was with Citi in their debt business, and Kreos Capital in M&A, so we're very pleased to have James. And Kate Madden joined us recently. Kate came to us from PwC's restructuring group and also did some work in KKR's private credit team. As part of establishing the venture credit product in Australia, we also reached out and formed a partnership with Viola Group in Israel. Viola Group's a $3 billion asset under management multi-strategy technology firm, and they've got a venture credit team that's invested about $1 billion over the last 18 years. And we formed a partnership with them, which means that they actually are supporting us with deals. And also, if we need to do larger deals than OneVentures can do itself, Viola can actually participate with us or help us with our companies when they're going global, because Viola actually invests globally all around the world now. So we're very happy with the partnership we have with Viola Group in Israel. So I'll hand over to Nick now to talk about the debt product and introduce himself.
Hi everyone. Just firstly, if you have any questions during the presentation, we're using Slido. So if you go to sli.do and the event code is VD101, you can add questions on there along the way and we can address them when we do the fireside chat afterwards. So just before starting, just want to give you some more colour on my background. I know Michelle helpfully kind of summarised it, but my background is kind of mainly in credit. So I started my career in London at KPMG doing corporate finance and then moved into their debt advisory team. So I was advising companies on their debt, spent loads of time negotiating with banks and helping people on their bank debt from kind of large cap listed companies on the FTSE 100, so kind of equivalent to ASX 20, right down to kind of mid-market private equity-backed businesses. I then moved from there to Kreos Capital, which is the largest player doing this in Europe. They brought the concept from Silicon Valley 20 years ago, brought it over to Europe and have built out a pretty large business. So from when I started 6 years ago, they were doing about 100 million Aussie equivalent million per year into the European market. When I left, they were doing about 500 million. So really, really strong growth in terms of the ecosystem in Europe. And hopefully, Australia follows in those footsteps and we see, growth in the market. So in terms of the slides, I first want to kind of touch upon debt in general, and then I'll move specifically onto venture debt. So most of you probably know some of this already or learn it at university or in your days studying, but basically the main difference between equity and debt are equity, someone's funding a business and is happy to take an uncertain return, but in exchange wants kind of unlimited upside. So they get paid through dividends or capital appreciation, whereas debt, you fix your return and you generally get it through interest and fees. Because of a lower return, debt holders are happy to, effectively take lower return, but want to take less risk. So because of that, they sit first in the capital structure and get their money first in a waterfall. Second as well, they're not interested in the same way in voting and directing that business because they participate less in that upside. So they're a little bit more passive. And lastly on here as well, in terms of risk to a business, it's kind of the opposite to that. So from a risk perspective, a company taking equity is lower risk for a company because ultimately you don't have to pay out any return if things aren't going well. Whereas for debt, the return, you have contractual payments to make out, so it's kind of higher risk for a company. And the last point along the bottom there in orange is kind of irrelevant for early stage startup, but in general around debt is you don't pay tax. The tax comes out after payments of interest. So it's actually very advantageous for a company from a tax perspective. So kind of a key fundamental point and benefit of debt is all around the leverage effect and the multiplier you can get through taking leverage. So just a really, really simple example, but if you had, let's say, $1 million and you wanted to purchase property, you could choose to purchase, say, one property for $1 million, or you may choose to take debt and get a mortgage on each property and spread your money. So if you bought 10 properties and put in $100,000 into each property as equity and spread that across and took a $900K mortgage on each property, then if the property went up by 10%, if you fully funded through equity, you'd make 10% on that money, whereas if you fully funded it with debt across all those properties, you'd actually double your money. But then conversely, on the opposite side, if things go wrong, you magnify the losses as well. So on this example, with equity, you'd have a 10% loss, whereas on if you funded through debt, you lose all your money. So it really has a magnification effect in terms of the percentage of funding in debt and equity. So here's just a few different examples of different types of debt facilities. So, and this is all around really repayment of the capital. So in the top left, a bullet loan, a term loan generally, you have a bullet at the end, is where you have a single shot payment, is why it's called a bullet. So your money here is outstanding for a period of time. You'll pay interest along the way, but then you'll literally pay it all back in one go. The kind of opposite to that is an amortizing facility where you pay down the capital through the life of a loan, which is much more consistent with venture debt. So that's in the bottom left there. The facilities on the right there just give examples of sorts of debt facilities which move up and down through the life of a loan. So a revolving credit facility is really lots of small term facilities, and lots of small term bullet loans actually through the life of a loan. And you may choose to draw down for different periods. And normally you'd pay the interest at the end of that period, and you'd pay down the capital, and then you'd redraw again. And you may have multiple tranches at the same time. So this is something that's not really common for kind of early stage businesses, but much more mature corporate facilities will all be structured like this. And then the bottom there in terms of an overdraft has a similar effect to an RCF, but the difference being it really moves up on a daily basis, and effectively you're offsetting cash in the account to the outstanding debt. Normally overdrafts are uncommitted, which means that the bank can pull it at any point in time. So it's fine for kind of managing small amounts of working capital, but I definitely wouldn't propose that you use it as a permanent form of capital, because there's risk associated with it. So now more specifically on venture credit and how it differs. So venture credit is a specific form of debt which is tailored for kind of high growth businesses, typically technology businesses. When I say that you can spend it like equity, what I mean is effectively the money comes in and it's very, very unrestricted. So you can spend that money how you like in the same way as if you raised equity financing. But side by side with equity, it's a lot cheaper. The last point is around really because of that leverage effect I talked about, you'd really leverage and improve the returns for other shareholders. The graph on the right explains the whole piece there around delaying financing rounds, but the black line there shows if you just raise money for a startup just through equity, effectively you'd move forward in time, you should have a step up in valuation when you raise money, and then you'll spend that money along the way and then raise again and get a step up in valuation. However, if you use debt as well, in addition, effectively you have more capital at any point in time, so you can go further in your journey before you raise again. Because you go further, you may be able to hit certain milestones in your business. Maybe that's a certain level of ARR. Maybe that means you've proven out a new product. Maybe that means you've gone into a new market, and therefore you're further along your journey and you'll have a larger step up in valuation. So actually by using a product like venture debt, what you're actually achieving is you're actually taking less equity overall and actually going further. So that's kind of one of those examples I mentioned there is all around, actually it bridges a few of these, but if you raised a round and you took some debt, some equity, you would basically take less dilution for the same amount of money. The second one there could be actually you come in between rounds. So it may mean that you're, say, between your Series A or between your Series B. And instead of bringing that Series B forward, you can choose to take some debt. It could be in conjunction with equity. And it will basically extend out your runway and give you longer and achieve more to the point before. Actually, with businesses which are a little bit more mature, it could be as not an alternative to equity, but it could be a fundraiser as pure debt. So it may come in between rounds in the same way, but it can be fully through debt. And the last one there, in insurance policy, what I mean by that is you're able to get a facility which is available to draw down, but at your option. So because of that, if things are going, say, not exactly to plan, and you still need to spend a little bit more to get to where your goal is, you can draw down on the money. If you don't take it. Or conversely, if the business is going very well, you may see more opportunity to invest, and therefore it's available to take down and really put your foot on the accelerator. So in terms of why raise venture debt versus equity, there's a few kind of pros and cons here which I've touched upon, but just to kind of run through. You're avoiding dilution through taking debt. You're not changing your board, so effectively you can bring on debt and you're keeping your existing board members, and bringing someone else around the table who can help you but isn't voting and directing the business, which can be really advantageous if you have multiple people around the table and you don't want to bring in someone else with another view and kind of confuse things or make things really busy. It's cheaper than equity, as I mentioned before, so it's kind of a really big pro. If you're taking it between rounds or in general, the venture debt provider doesn't require you to set a valuation. So you may avoid that discussion, which can be really important if you don't want to raise or the business isn't exactly how you want it to be to raise money. So you could choose between rounds to take debt. You're not setting a valuation because it maybe not show the same uplift you want, or you haven't quite achieved what you want to get that valuation. And it can be done alongside, a convertible loan from shareholders as well. And again, you're not pricing around. Depending on who you get the money from, you may be bringing a new venture investor on board. So with OneVentures, you get to get the benefit of kind of the wider OneVentures platform and the expertise and experience which Michelle mentioned, but while not bringing on another shareholder and taking that dilution. And speed is also really important. So as a venture debt provider, given you're taking less risk because of where you sit in the capital structure, and generally side by side you're taking less money, the process can be much, much quicker from our side. So typically we can take about 4 to 6 weeks from meeting someone to getting money in the bank account, which, compared to an equity round could take you 3 to 6 months, say. So much, much quicker. Nothing's for free, and there's always downsides with everything. So to explain some cons for you, the major one is you're sitting senior to equity. So as an equity holder, you're bringing someone else ahead of you, even ahead of preference shares. You've got to pay interest, so it costs you money, and that interest is contractual. It doesn't fit every situation, so it's not always, let's take some debt and not take equity. If a business isn't performing that well, or it doesn't fit the exact profile, then you may not be able to access debt, and I'll come on to different examples shortly. And lastly, like I mentioned, it's generally smaller than equity and will form part of the overall financing. But normally, if you took a round, you'd raise more equity as a proportion than debt. So in terms of what the profile looks like of the product, it's a loan, which you pay down over time, so it amortizes. There's usually an equity option, which we say is warrants, which means we participate in that upside, which means our interests are really aligned. So we want to grow the business, help you, and reach an exit, and we'll participate in some of that upside. It's senior and it's secured. We don't take directors' guarantees, though, so we're not looking to take your house or any other assets, which is something a bank would definitely ask for if they were to give you a loan at your stage. And we're generally covenant light. And what I mean by that is we're not restricting you in the same way a bank loan would. It's much more flexible. And in terms of financial covenants, so specific targets you need to hit month on month, we're much, much lighter. So there may be no financial covenants at all, or there may be light financial covenants, which really gives you the space to grow your business as you want. We want you to maximize value in the business, and we don't want you to be worrying about tripping, let's say a revenue target 1 month or a max burn target. So by giving you that flexibility, we let you really grow. So this is just showing you diagrammatically a picture of what it looks like from a ranking perspective. So venture debt would normally sit right at the top as senior debt. You probably wouldn't be accessing junior debt as an early stage business, but later stage businesses, you may be able to get some junior debt. Shareholder loans, which really are a structural form of equity, would then sit below. Then pref equity, and then ords. So just giving you kind of a snapshot on kind of high level terms and the sorts of things to expect with a product like ours. For us, we look to do loans between 500K and 5 million. That may differ depending on different partners, but that's the kind of a size we look at. We can co-invest with our partner Viola, the Israeli partner, and do loans much bigger. So we looked at a 20 million loan with them. Or we can actually invest with some of our LPs as well who are really interested in doing that. So with that, it gives us capability to really do most things which are available in Australia. From a term perspective, the length of a loan, typically a fairly short term because there's only so much visibility we can see in terms of a business. So normally we'll lend kind of anywhere between 12 and 36 months. Potentially in some cases we can go as long as 4 years, but we're not doing long loans of 7, 8 years or anything like that. Interest rates are generally kind of low double digits percentage. You don't have to draw down all the money up front, like I mentioned before, so there may be a period of time where you can take the money. We talked about repayment, paying it through the life of a loan. Purpose is really, really broad, so we're not restricting you on what you're using your money for. It will fund general operational burn, but normally it's any form of expansionary capital. So often it's used for, it can be marketing spend or building out a sales team to really accelerate growth. Could fund R&D and CapEx. Generally, it's not, and people are really comfortable to use equity for those sort of longer-term investments, but you're free to use it like that. Also, we can fund acquisitions as well. So if you want to bolt on other businesses, you can potentially part fund them with debt and part with equity. We're always senior secured, but depending on the business, some businesses have a lot of assets, be it a business that might have a lot of inventory or a lot of receivables. When a business gets a bit more mature, then you can potentially carve out specific financing around those assets. Covenants are light. There's some fees to put the facility in place, and potentially fees if you have it available for a long period of time. From an information perspective, really we like to see the same information a board would receive. So our kind of mantra is, look, we're lighter on covenants and give you flexibility, but in exchange we want to have a lot of visibility of your business. And that means we can really help you through good times and also bad times. So we like to be board observer. We're not telling you what to do. We can give insight and help you, but it really helps us quicker in terms of responding to different situations in the future. The equity component is the equity option I mentioned before. If you kind of translated it into percentage of cap table, it's probably going to be somewhere between kind of 1% and 4% of a company. But that depends on the size of a loan, the valuation of the business. So it's lots of different parameters there which influence that. And the last one there around investment rights. Really what we're saying there is, for us specifically as OneVentures, we have the ability to also invest equity. We could do that out of the equity fund, which is separate, but here, from a debt fund, we can actually provide opportunistic equity and help out the company in a small degree through equity, which not every fund can do. So in terms of stage of business, what we look for is a business has gone through that initial kind of startup phase. It's kind of proven product market fit, is revenue generating, is scaling, and from a unit economic perspective, is a little bit more predictable. So you understand your kind of unit economics. You understand how much it costs to acquire a customer, what the lifetime value is, what the payback period is going to be. You understand your churn, and because of that, you know that if you take some debt funding and you invest, you understand what the return will be. If a business kind of is still finding its feet, and you take some money, invest, and you kind of can't necessarily predict the return, I'd kind of suggest not taking debt at that stage, because all it's going to mean is you're going to increase your monthly burn, and you may not get the desired result. We like to see kind of high growth businesses. Typically, we look for kind of a minimum of 30% growth. The higher the growth, the more attractive the product is, because if you're comparing the cost of debt to the cost of equity, the higher the growth, the higher the cost of equity effectively. We want to see equity invested in the business. We say here kind of a minimum of $3 to $5 million invested in the business, but that can be alongside us as well when we come in. So normally we say we want to be in as kind of Series A as the absolute earliest entry point. And ideally those are kind of institutional investors or VC investors coming on board with us, because they really help, one, drive that business towards an exit, two, they're hands-on and can help people along the way, but three, they're part of our overall funding base. We don't want to be the only person with money around the table, because we're not getting paid for that. So we want to be kind of part of our overall package. And the last point there, and kind of I've mentioned it before, but really key, is we're really happy to lend to cash-burning businesses, which bankers wouldn't do. You can be profitable, and that's great, and we can structure something slightly different if you're profitable, but likewise, you can be cash-burning, and we're fine with that, provided you're kind of meeting those other criteria there. And normally it's best suited to tech. We only look at tech or kind of tech-enabled businesses. The reason why it works better for those sort of businesses is, one, they're kind of not capital intensive. They're really scalable if you invest. And two, you're getting that growth which you kind of need to make this product work. So it's all around the fact that valuations are increasing very quickly, and therefore by delaying those kind of capital raises, you get a lot of benefit. So that's why it fits tech well. So just to kind of give you an example of the cost comparison between debt and equity, just a simple example here of taking a 3-year loan of $3 million, And if you compared that to fully funding it through debt versus funding it through equity, and this example shows you're coming in at 30 million pre-money, so you roughly get about 9.1% of the business, and you exit at 150 million. In this example, if you fully funded it via equity, you're paying out that equity holder 10.6 million of profit, whereas if you funded it via debt, you would actually only pay out 1.9 million of profit. So it's actually about 5 times cheaper, so a huge differential in cost. Obviously, the higher growth you get in equity, the more swing it is in terms of equity being more expensive relative to debt. And the key benefit of that is, founders and other investors around the table effectively retain more of that, pie, more of that value of the business, which all comes around the leverage effect of the debt. So often get asked the question, well, how does it compare to a convertible? What other sorts of debts are there out there? These are probably the only sorts of debt you'll access as an earlier stage business. The convertible in the middle, like I mentioned before, it's not really debt. I mean, it's debt while the convertible is outstanding, but anyone who gives you a convertible or gives you a safe note is really doing so to put in equity in the future, and it's really a mechanism to kind of not set the valuation and structure kind of a time period before that money goes in. So typically that's not secured relative to venture debt being secured. There's good flexibility. There's much more dilution from a convertible because I put 20% here saying that a typical round is about 20% of your equity relative to kind of a small amount of dilution from the warrants. Generally, there may not be any cash interest, but there may be rolling up interest, maybe say 8 to 12% on a convertible, whereas kind of venture debt is probably not that dissimilar, but kind of low double digits. For the kind of size of round, normally it's part of, like I mentioned before, part of the funding round, but we also look at ARR as a way of kind of approximating how much debt a company can support. So normally it's kind of 10 to 40%. And it comes with a loan and also the options. And just comparing the working capital piece on the far right, what I mean there is, if you have a lot of assets, we mentioned the working capital line, those facilities are very structured. They're specifically used for certain type of asset funding, so they're not very flexible. They're often cheaper because it's very specific and someone provided that gets a lot of comfort around that asset base, and they'll set covenants around how much headroom they have. Likely to be a smaller amount, but actually, as you get larger, if you have a lot of assets, then it could be, much more than that. I mean, if you're looking at fintech businesses, you may be a lending business, and therefore you may have a loan book. I mean, you might be able, I wouldn't really describe that as working capital financing, but it is a specific structured type of finance. So that's probably the most applicable thing for fintech. So in terms of when I wouldn't recommend taking venture debt, I mean, the main reason is really you're not at the right stage or you're not the right profile business. So all of the pieces on the left there I've kind of touched upon. On the right, really what I'm trying to get at there is kind of, well, how are you using that money and what's the kind of current situation of the business? So if you can't raise equity and you're thinking, well, I can't raise equity, let's take some debt, I really, really wouldn't recommend it, because that means fundamentally there's an issue of why someone doesn't want to give you equity, and all you're going to do is create a higher burn and really drag that business down. So really it's a complementary product where you can raise equity. The business is performing, so if it's underperforming or it's going through a turnaround again, I wouldn't recommend taking debt, and probably someone won't provide it. It's always important never to put too much debt into an early stage business. If you're really, really putting a burden in terms of burn, all you're going to do is make it hard to make those repayments and create an issue down the line. And also, if you put too much debt into a business, someone might question, an equity provider in the future may question why is there so much debt and be uncomfortable. If you have a very, very short runway as well, and you're saying, well, look, either you're in a process of a financing round or you're about to kick one off, and you say have, 3 months runway, and you're thinking, well, I don't want to take equity and dilute at this stage, why don't I just take some debt? It's pretty dangerous. And generally, the provider of debt, someone like ourselves wouldn't do it because we're really not getting compensated. There's risk there around can you complete the financing irrespective of the quality of your business, and therefore, it's more risk than we want to take. And lastly, the one there is in terms of pivoting. If you're changing your business model and you haven't necessarily got the product market fit of that new model, again, you should kind of test it out, make sure it's working, generate revenue, and then think about taking debt. So something people often dismiss, and it's valid for taking equity as well as debt, is kind of who are you taking that financing from. So, I'd really recommend that, you do your diligence on who you take the money from. Make sure you understand, well, who are they? What's their experience through good times and bad? Have they provided such product before? And, importantly, do they have relationships with your investors and directors? Because ultimately, if they know people and people trust them, that's kind of key in terms of working together. Taking money from a provider like us isn't the same as taking a bank loan. You will hear from us. We want to be board observer. And you're going to have to work with those people. So that's kind of a key point. So a question which someone sent over Slido before today was, well, how big is the market? And how big is it in Australia? And why hasn't it existed here before? It's a really hard thing to approximate because it's not really that public. But PitchBook did a study recently on kind of the size of a US venture debt market. And they kind of estimated that in 2018, it was valued at between kind of 2.5 and 4 billion US dollars. So pretty large, and you can see there's been a massive growth in the product. Typically, it represents, for later stage businesses, about $1 in $4 invested. For earlier stage businesses, it's kind of between 10 and 15% of money raised comes through debt. So it's always a smaller proportion, but it's pretty sizable still. So if you kind of translated that into Australia, you're probably looking potential maybe of kind of 200 to 300 million Australian dollars per year. Kind of my view of why it hasn't really been a product here is, one, the immaturity of the VC market. Once the market becomes more mature, there's more funding, there's more businesses, there's more sophistication around the product. I think it comes about and comes into play. And also I think Australians are pretty conservative as well. So people are cautious about taking on risk. Even though from a consumer perspective, people are very familiar with credit. So I think it's just taking time for people to kind of understand kind of how the product works, and then more and more people, will start taking it. And we're seeing really good demand for the product actually since we've launched. So in terms of how it's used globally, it's like I mentioned, it's really, really common, and there's a lot of large companies you would have heard of would have taken money. So you can see here, the likes of Google, Amazon have taken venture debt, and even some Australian businesses have taken similar products before they existed, WiseTech and Econex. So really, really common product globally. So that's basically it from the presentation. What we're going to do now is move on to a fireside chat. We have the opportunity to ask kind of any questions you want. So I'm bringing James up for stage as well, and also Will from Shippit, which is one of our portfolio companies on the debt side.
I should say that James was instrumental in pushing OneVentures along the route of setting up a venture debt program. So,
hi everyone, my name's Will On. I'm co-founder of Shippit.com. We're an Australian logistics platform working with many of Australia's largest e-commerce retailers. We've been around for 4 years. We've got close to 100 staff, and we're starting to offshore our experiences into Southeast Asia. And I also noticed Guillaume and Harad. I used to work for you guys at Deloitte, so g'day.
Yeah, hi, I'm James McGrath. So I've worked at OneVentures 4 years. I was on the equity side for a few years before, and I've been with Nick and the venture debt team for a year. So I've been where most of you probably are, which is just 1 year ago, or a bit more than that, not knowing anything about what it was, not really getting my head around it, being a bit, seeing some of these same slides online myself. So hopefully be able to bring you on the journey with me and help you understand it.
Cool, thanks. And I suppose, Will, first question to you is why did Shippit decide to take venture debt? How does it fit into your business, and what led you to make the decision to do it?
Sure, it was probably mid last year where we were going through a round of capital raising. At the time, we probably had about 50 people doing, maybe 3-4 million in ARR. At that point in our business, we were we need to really double down on our growth and our basically our team. We went through all the normal channels that you'd go through. We went through straight equity, going to talk to all the VCs. We went through bank loans, looking at invoice financing, looking at overdraft facilities, so all those different credit facilities that you put up earlier, Nick. But really, the reason why we went down the venture debt path was talking to one of our investors from the US. It was really clear that if you have a clear strategy in terms of being able to increase your valuation over the next X number of months, so you really have a clear way of deploying your capital, it's a really cost-efficient way of being able to do things. So the slides that you presented earlier, Nick, you can see that, the cost of venture debt versus traditional equity is a lot cheaper. Obviously, the dilution for founders and existing shareholders is a lot less. And that kind of is really what brought us down that path. Your slide earlier around the maturity of the market in Australia probably isn't there, but we had connections into the US who told us this is a pretty standard path to go down.
Cool. Helpful. And I suppose, James, in terms of one question which people always ask is, well, what happens if things go wrong? Are you just going to take my business?
Yeah, I think it's a great question. Whenever people think about debt, they think about, oh, it's risky. One of the key things to know is that when we give a loan to business, if things don't go well, we're not going to take the business. So we're a startup, without the founders, without the people, without the strategy, without the future. It's just some desks, some laptops, and that's it. There's nothing to really take as a lender. So if things don't go well, it's the same things if your startup is not going well normally, which is you need to sit down with your board and have a strategic discussion. You might need to slow burn, slow marketing spending. You might need to have your current investors put a convertible note in or some money in, or have new investors come in and put some money in, extend the runway. So it's really all this, and we would just be sitting there giving ideas and giving input and helping out where we can. So it's really, if things don't go well, it's just the same. And I think, Nick, you were saying in your experience in Europe, having done, I think, over 100 transactions, the number of times we actually step in is zero, never. And if the really bad thing does happen to the business is sold, the only difference is that we are senior debt, so we get our money out first. But to be honest, often in those terrible cases, there's not much to kind of get back as it is.
Yeah, and I think that's fair. I mean, ultimately, if a business is going to fail, it's going to fail. Provided you haven't put too much debt into the business, then that shouldn't cause that difference. And likewise, if you try and fire sale a tech business, like you say, no one's going to get much money from that. So we're incentivized, and we want the business to do well. We want to have value in the warrants as well, and that's really important. So cool. And James, I mean, what in terms of taking a loan from someone like OneVentures, I mean, what other value can you receive from getting taking a loan? What value add can we do?
Sure. Yeah, so I mean, OneVentures is a platform. We have 400 million under management. We've got 140 investors. Got a whole team. We've done technology investing in Australia for 10 years. So the advantages of taking a loan from OneVentures is we can still give all the benefits, or most of the benefits, that a venture capital provider can. Introductions to board members, CEOs, who are investors who want to get involved in the companies. We're in 6 SaaS companies. If you have a SaaS company, we've probably seen the problem before. We are well connected throughout the market. We have a good reputation. We provide some, having the OneVentures name as a brand helps you attract talent, helps you attract future capital. So I'd say all the benefits of getting a strong venture capital investor in, but just through a different instrument.
Cool. Any tips, Will, in terms of just the guys here, in terms of financing and how you thought about looking ahead to different financing options? Any kind of wider tips on?
Yeah, sure. I can completely vouch for the commentary that James had.
Thanks.
A wise man once told me that culture eats strategy, and with that in mind, it was more around the team that's around us. So it was funny that 5 years ago we did a pitch out in Perth, and Michelle was the judge on that pitch. And even though we came second, she still wrote a check for us, so that was great. A couple years later, James passed on us during our Series A.
Yeah, that's true.
But it's funny how things come around.
I think quite politely, though.
But that being said, the team at OneVentures have got a really good network and team around them. They've been around for ages. When the deal broke on the AFR, I had a lot of other investors reach out and say, hey, you guys getting OneVentures on the cap table is pretty awesome because they've been around the traps, right? Even though it is a new instrument, as what James was saying, I've got client referrals from Michelle. I've been to coaching stuff that OneVentures puts on. I've been to a presentation day with all the LPs at OneVentures. Irrespective of whether or not it's through credit or the VC fund. So it's all those things that have been really beneficial for us, which is why we picked you guys from as a provider of the facility. Not to say that there aren't other providers out there, but I think you guys come up on tops on that front, which is great. In terms of tips for fundraising, if you know much about Formula One, it's very much it's the right time, right? If you fill up too early, you lose out. If you fill up too late, you run out of money. It's basically, yeah. And a piece of advice that I got given starting up really early on was yes, as a founder, I want to build a company and do stuff, but raising capital is a part of the job, right? And people often start off thinking, oh, it's just this other thing or this distraction that I need to do. I think I've come full circle on that, and it's this is part of the job, being able to add multipliers to the team. So yeah, I think being able to get the board on side, being clear on your capital strategy, and really not kicking things down the road for too long, and being clear on what the strategy is and getting everyone on side and really going after it. I mean, we made a mistake last year where we spent 5 or 6 months deliberating, should we raise, should we not raise? And that really killed our board process and what we could do. So being really definitive about what your strategy is, I think, a really important piece of advice I've got.
Cool, thanks. And James, in terms of talking of fundraising, you take debt, you then do another fundraise. Do you just pay back that debt? I mean, what happens in that situation?
Yeah, I think that's a softball question for me. So that's a misconception that a lot of people have, is that it's a bridge loan, and then when the equity round comes, you pay back the debt with that. And the reason we don't do that is new equity investors would not want to put in money to see a debt holder repaid. That's why it amortizes out. So yeah. And I just want to say on the tips from before point, I think a really good tip for raising VC or venture debt is that get to know the VC or venture debt provider early. So if you can, just get a meeting 6 months out from when you want to raise. I just want to catch up with you, tell you about my business, get to know you, build a relationship. I think a lot of people in Australia still treat it like, okay, now I need, don't speak to them at all, save up, or wait until my news is perfect and then come and say, look, I've got my business looking just the way I want it. Can you put the money in now? And dating, anything, you want to kind of build it slowly and build a relationship, and that's a much better way.
It's really about showing track record. Right now, I've got 3 VC conversations a week with other investors. And the reason why that is it's all about saying, hey, I went out to commit and achieve these goals. I've been able to do that. So my future goals are going to be like this. Do you want to come for the party? Yeah.
Cool. And there's going to some questions on Slido. So I think the top question you've said on here is kind of, how does the warrant work, basically? Are we looking to take, how does it work? Are we getting a discount to the market? Are we looking to become a shareholder?
Yeah, so the reason we do a warrant is it allows us just to get exposure to the upside of the company that we're helping fund, but we don't want to sign up to the shareholders agreement and have those obligations. So the way it would work is if it's something like $1 million loan, then we would take $200,000 worth of shares at a price to be agreed, and then we wouldn't look to exercise that warrant, and hopefully someone comes along, buys the company in the future, and at that point we exercise the warrant and receive the difference. So if that helps explain it.
Cool. And another one up here is saying, we're a buy now, pay later company. Could we use venture loan to fund effectively the loan book on that?
Yeah, so people have done that actually. So normally the process for fintechs is they start and then they lend off their own balance sheet. They get a bit bigger, they raise some venture capital, and then they might do some venture debt there, maybe in between an A or B or around that stage. And then the final stage, the afterpay and so forth, they have a vehicle that just holds their receivables and payables. So yeah, it is actually possible. It's not something we've done yet, but I think it's something you've done in Europe, right?
Yeah, no, I think it definitely happens. Normally it's the earliest stage of the business, so effectively, the lender gets comfort that there's assets there, because I'd say venture debt is neither asset-based lend or a cash flow lend. It's kind of a really holistic approach. So if you have those hard assets, you've got a loan book and you've got low defaults, then that provides good security. But typically, you'd outgrow a venture debt provider quite quickly to fund that sort of financing, because ultimately it's going to be more expensive than specific financing, depending on what you're lending out at. But if you're lending to, let's say you're lending to businesses at 5%, you're going to be making a loss on that money. So you may use that to fund initially, get some track record, get some data, and then you're going to be out in the market, probably going to a bank or specialist provider to bring down that cost of capital.
Should probably mention actually our partner Viola. They have a specific fund that's a global fund that specifically lends to online lenders to lend on themselves. So if you're interested in that, then you can speak to us and we can put you in touch with Viola.
Cool. And another question here is kind of what kind of security do you require? What sort of security do you take for
So
that?
we just take security over the business and not over the founders' houses or the founders' personal guarantees or anything. So just over the business, which normally includes the IPs, the customers, the operations.
But just to be clear, it doesn't restrict you from doing anything. So it's more that you're free to trade with your business. If you have inventory or assets, you're free to trade in and out of those assets. It's very much, it's a protection mechanism, but it doesn't stop you doing things. So you're fully free to use your IP as you wish. It's more that it gives protection against the loan. It's the same way if you took a mortgage over a house, you're free to use your house. It's just the bank's got that in case for protection if they need it. Well, thanks everyone. If you have further questions, you can come and ask us directly outside and we'll kind of move over to networking. So thanks.